So this is a great time, students. We meet again for the session of advanced financial reporting and analysis. So it's a continued session from the topic we were doing in our previous class, the last week class. So I was talking about earnings per share. So we did an introduction of basic earnings per share. So now I will be continuing with the diluted earnings per share. Then generally when doing diluted earnings per share, that is to be more specific, when I will be doing a question, I would have to start again from basic because that is the first step for diluted. Then we continue with the diluted. So what is diluted earnings per share? What is the diluted earnings per share? So from the word dilution, so when we talk about diluted earnings per share, we mean this, diluted earnings per share. So the diluted EPS is a reduction in value, So from the word dilution, when something is diluted, it does what? It decreases in value. So what is decreasing? Now that is what we need to know. So diluted EPS signifies a reduction in the value of basic EPS. So the diluted earnings per share shows that there will be a reduction in basic EPS. So according to the relevant standard, that is I-33, a company is meant to disclose both basic and diluted. That is what I said when I introduced the topic. I-33 states that you need to compute what? Basic and diluted earnings per share, with the diluted being a what-if analysis. Diluted being what-if analysis. So the diluted EPS indicates to the users that there is a possibility that the basic EPS will decline in the future if the number of ordinary shares increases. So where are these ordinary shares increasing from? So if there's no possibility of the increase in number of shares, then the basic EPS and the diluted EPS are the same. If there's no possibility of increase in number of shares, then the basic EPS and diluted EPS are the same. So when we will be dealing with the aspect of diluted earnings per share, when we talk about that there's a possibility that the basic EPS will decline in the future if number of ordinary shares increases. So where are these number of ordinary shares are increasing from? So they are increasing from the conversion of potential securities to ordinary shares. So the potential securities, these are securities which are likely or unlikely to be converted to ordinary shares. So the potential securities are the securities which bear the word convertible. Like now we have convertible preference shares, convertible debentures. So the securities which bear the word conversion. So when they say whatever, it's computed on a whatever analysis. Remember that we will be assuming that these securities which bear the word conversion, are going to be converted to ordinary shares. Even if in the question they will never specify that they are converted. Once they bear the word convertible, even if they will not specify that the securities have been converted to ordinary shares, once they bear the word convertible, we know that these are potential securities. So they are likely to be converted to ordinary shares. So we assume, we do assume that they will be converted to ordinary shares. And due to this conversion of the convertible securities, that is what tells us that there will be an increase in the number of ordinary shares. And that is what is well explained in the notes, that the diluted EPS indicates to the users that there is a possibility that the basic EPS will decline in the future if number of ordinary shares increases. If there is no possibility of the increase in the number of the shares, then the basic EPS and diluted EPS are the same. The possibility of a decline in the basic EPS arises when the firm has promised to issue new shares in the future. They have promised to issue new shares in the future. That is potential ordinary shares. So the potential ordinary shares. So what are these potential ordinary shares? So we always say that potential ordinary shares are convertible securities. Convertible securities. That is, securities whose holders are entitled to ordinary shares in the future period. So I have given examples: convertible debentures, bonds or loan stock, convertible preference shares, option and warrants. So those are the convertible securities, the ones which are likely or unlikely to be converted to ordinary shares, of which I have said we always do what? Assume. We always do an assumption that they have been converted to ordinary shares for us to compute diluted EPS. Because if there will be no increase in the ordinary shares, then the basic EPS and the diluted EPS will be the same. So steps for determining diluted EPS. The first thing you are supposed to do is the calculation of the basic EPS, the powers divide the 1/0. Step 2, determine the order of ranking the securities. You determine the order of ranking the securities. So we always rank the securities from those which have a least effect to the basic earnings per share. So we will be looking at these potential securities which will be incorporated in that question you will be doing. So after doing my analysis, after doing my relevant analysis, I will be able to check which potential does these securities have in diluting my basic earnings per share, which is the potential they have in diluting the basic earnings per share. So that I will be able to compute my diluted EPS based on the ranks which will be done, of which I have said I will rank them from those which has a least effect in diluting the basic EPS. Because we have said generally diluted EPS signifies a reduction in the basic earnings per share. It signifies a reduction in the earnings per share. So NB, about a profit, when computing for diluted, the profit which we are supposed to use is from continuing operations only. But for basic, we always use profit from both continuing and discontinued operations. So that is a short introduction for diluted earnings per share. Then I would like to go direct to the question of December 2013, question 4. December 2013, question 4B. December 2013, question 4B. So from this past paper, which you have, but even if you don't have it shared on the screen. So let's check this question. The capital structure of JAMA Limited as at 31st March 2012 was as follows. So you are provided with the capital structure of a certain company as at the end of a certain year, 31st March 2012. Why am I saying that the end of a certain year? Because the requirement down there, you are supposed to do the basic earnings per share and the diluted earnings per share as at 31st March 2013. Meaning that if our financial year ends on 31st March 2013, it's supposed to start when? 1st April 2012. And that one shows that the transactions given at the start of the question, yes, they are the closing for the previous year, which means that there will be transactions, there will be securities opening the current year. So you have the ordinary shares, 6 million, giving us a value of 30 million, 2 million, cumulative preference shares, giving us a value of 20 million, 12% convertible bonds, giving us a value of 25 million. Additional information, During the year ended 31st March 2013, the company reported profit after tax of 85.6. Number 2, on 1st May 2012, the company issued 1.5 million ordinary shares at full market price. Number 3, on 31st August 2012, the company made a rights issue of 1 ordinary shares for every 4 ordinary shares held on that date. The exercise price was shillings 36 per share, and the CAM rights price on the last quotation was shillings 48 per share. So you can see we have a rights issue. And that one means what is supposed to click in your mind when doing your nose. Automatically, you have to remember that formula. Number 4, on 1st January 2013, holders of 10 million 12% convertible bonds exercised their conversion rights. Each shillings 10,000 of the bond is convertible into 250 ordinary shares of shillings 5 each. Number 5, on 1st January 2013, employees of the company were granted share options to purchase 1 million ordinary shares for shillings 30 each. The average market price was shillings 48 per share. As at 31st March 2013, none of the employees had exercised their options. The corporation tax rate is 30%. Required, you are required to do basic earnings per share, then do the diluted earnings per share. So the presentation, so December 2013, question 4. So they are asking about basic earnings per share and diluted earnings per share. So when we talk about basic earnings per share, so the basic EPS, earnings per share, when we talk about the basic earnings per share, we always say it's equals to PAUS over 1 OS. So PAUS means profit attributable to ordinary shareholders. 1 OS is weighted average number of ordinary shares. So how do you get the PAUS? PAUS. You start with the reported profit for the year. Reported profit for the year. So the reported profit for the year. So under the reported profit for the year, what am I supposed to raise? Preference dividends. So these are the dividends to preference shareholders. Preference dividends. And again, I deduct profit attributable to NCI. NCI, you know it from afar. Non-controlling interest, minority shareholders. So checking in our question number 1, that is not number 1, our question number 4 in December 2013. Under that question, in additional information number 1, they said during the year ended 31st March 2013. Additional information number 1. During the year ended 31st March 2013, the company reported profit after tax of 85 points. The company reported a profit of 85.6 million. So meaning that this is in shillings in million. So let us reduce that way. So was there a preference dividends? So checking in the relevant question, at the start of that year, you were told that there is a capital structure which was given, which has 6 million ordinary shares, 2 million 10% preference shares, 10% preference shares. So this is the case. So 2 million 10% preference shares. The value is 20 million. So meaning that the dividends will be paid based on this contractual rate of 10%. So 10% of 20. So 10% of 20 is 2. 10% of 20 is 2. So this one you deduct. Profit attributable to NCI. There is no profit attributable to the NCI, meaning that we have 83.6. We have the 83.6. So let's check for one-offs. So what you need to know is that when there's an aspect of when there's an aspect of a rights issue, there's that formula you are supposed to use. So which formula do we have to use? We always say ordinary shares before rights issue. Ordinary shares before rights issue. You multiply with fair value before rights issue, fair value before rights issue, times the period before rights issue, times the period before rights issue. So what you have from our first formula, you add with ordinary shares after rights issue, times the period after rights issue, So the period after rights issue. So remember that we need ordinary shares before, period before rights issue. So here there's something we need to include. The fair value before rights issue divide with the theoretical ex-rights price. So we always say ordinary shares before rights issue multiply with the fair value before rights issue divide with the theoretical ex-rights price times period before rights issue. Add with the ordinary shares after the rights issue times the period after rights issue. So we need to do analysis of shares to be applied in the formula, analysis of shares. We need to get the shares to apply in that formula. So meaning that I will say date, details, shares. So I need to get the shares to apply in my formula. Date, details, shares. So remember that our financial year was ending on 31st March 2013. So meaning that it starts on 1st April 2012. So the balance brought down is all about the shares which were given as at the end of the previous year, based on the capital structure which was provided there, based on the capital structure which was given. So remember that as at 31st March 2012, you can see the capital structure here. It includes 6 million ordinary shares, 2 million 10% cumulative preference shares, and we have 12% convertible bond. So this is the end of the previous year, meaning that these are the transactions as at the start of the current year. So 6 million ordinary shares, that is what we open with, 6 million. Going to additional information, number 2, because number 1 was all about profit. Additional information number 2, you are told that the company did what? The company did something. That is on 1st May. On 1st May, the company did something. Number 2, on 1st May 2012, the company issued 1.5 ordinary shares, the number 1.5. So that is on 1st May 2012. On 1st May 2012, new issue. We have the new issue of 1.5. Then going forward to note 3, there's this 31st August 2012. So 31st August 2012, that is when they made a rights issue. That is when a rights issue was made on the proportion of 1 ordinary shares for every 4 held. 1 for 4 held. 4 held on that date. As at this time, the number of shares held are 6 plus 1.5. So we have 7.5. We have 7.5. So how many shares they issued through the rights issue? So we close multiply. We do a close multiplication. So we say 7.5 times 1, 7.5 times 1 over 4. 7.5 times 1, you divide by 4. So what do you have? I think you have to give me the answer.
875.
875.
So that is 1.875. So those are the number of shares which were issued through the rights issue. So continuing to additional information number 4, they are saying that on 1st January 2013, holders of 10 million 12% convertible bonds exercised their conversion rights. Each shillings 10,000 of the bond is convertible into 250 ordinary shares of shillings 5 each. Convertible bonds, these are potential securities. They can only be used in computation of basic earnings per share, and they would specifically affect one-offs if they are specifically converted. Here now, there's no assumption that they are going to be converted. When doing one-offs, for us to incorporate convertible securities, they have to be specific that they were converted to ordinary shares. Like now, on this scenario, they were very specific. Remember that based on the capital structure above there, we have 12% convertible bonds. Their value is 25 million. In note 4, they are saying, on 1st January 2013, holders of 10 million, 12% convertible bond exercised their conversion rights. So meaning that they exercised their conversion rights. Each 10,000 of the bond is convertible into 250 ordinary shares. 10,000 of the bond is convertible to 250 ordinary shares. So we have to incorporate them here. So by saying that, the date was 1st January 2013, conversion of bonds, or the conversion of bonds to ordinary shares. In which proportion they converted? Every shillings 10,000, every shillings 10,000, every shillings 10,000 was converted towards 250 ordinary shares. So here, they said that shillings 10,000 was converted to 250 ordinary shares. So out of the 25 million convertible bonds, they converted 10. They converted 10 million. So they converted shillings 10. So they convert, in which manner did they convert to ordinary? So here we say 10 times 250 over what? 10,000 over 10,000. So what do you have?
0.25.
0.5, 0.25. All right. So that is it. So because in the next additional information, what was there is concerning the options. The employees of the company were granted share options to purchase 1 million ordinary shares of shillings 30 each. The average market price was 48. As of 31st March 2013, none of the employees had exercised. So none of the employees had exercised. We can only incorporate them in basic earnings per share if they could have exercised. And this one is what I mean here. And I think these notes, you have them. Under options, the company is requiring to sell at a price that is less than the market price at a future date. What is the company selling? Shares. So when the options or warrants owners exercise their rights, so if the exercise is carried out during the financial period, then in computing basic, or the shares on issue on the exercise are included from the date of the issue. If they do what? If they exercise, we include them. We include them. Then, if no exercise, that is, however, if no exercise takes place, like now in our scenario, then we assume the exercise took place for the purpose of computing diluted. But now, if no exercise took place for basic earnings per share, it will not be affected. We could have incorporated them if they did what? If they exercised. So meaning that now I can apply the shares in our formula. Ordinary shares before the rights issue is up to this point before. So the one knows would be 7.5 times the fair value. So for the fair value, you go to that additional information number 3, whereby they have mentioned the aspect of the rights issue. And you know, obviously, the fair value would be higher than the price of the rights issue from the divination itself. So going to that additional information number 3, what did they say? Number 3, they said this. In that additional information number 3, they said on 31st August 2012, the company made a rights issue of 1 ordinary shares for every 4 shares held. The exercise price was 36, and the come rights price on the last quotation was 48. That is our fair value. The exercise price of the rights is 36. So the 48, the price on the last day of the quotation. So for the theoretical exercise price, we have to compute that. We have to do a working for that, for the theoretical exercise price. So we have to do a working on that. So which working do I have to do? I would have to use the proportion of the rights issue to get theoretical exercise price. So the proportion was 1 for what? For 4. So remember that the 1 share they are purchasing at what price? Lower price, 36. So we say 1 new at 36. Remember the 4 are the one which were existing with the shareholders. So I say 4 old at the fair value, the market price, the price on the last day of the quotation, 48. So multiply this and this, that is 36. 4 times 48 is 192. That is, it was 48. So 192. So this is 192. So what you do, you add this and this. This is 5. 192 plus 36. So this is 228. So take 228 divide by 5. So 228 divided by 5. So here we have 45.6. So 45.6 times the period before the rights issue. Remember that our financial was ending when? Our financial was ending on 31st March 2013. 31st March 2013. It was starting on 1st April 2012. The rights issue occurred on, according to note 3, 31st August 2012. So from April to August, how many months are those? April, May, June, July, August. 5. 4, 5, 6, 7, 8. Those are 5. So this is 5/12. You add with what? Ordinary shares of the rights issue are the one before plus the one through rights issue plus the one through the rights issue. So 7.5 plus 1.875. So that is 9.375 times period after the rights issue from 31st August, meaning that is 1st September 2012 to 31st March 2013, those are 7 months. So you say 7/12. So that is what the formula gives us. But remember, there's something here. There's these shares, there's this bond, there's this, not this one, but this. There's this bond which was converted to ordinary shares. Even if it has not been incorporated in our formula, remember that there are shares which were there in that relevant year. They arise due to the conversion of the bond. So when we have shares, then you have to compute for the ones. What are you supposed to do? You weigh them from that time. So I will consider, so once I give the answer here, I will consider 0.25. I weigh them from which period? From this time of conversion to the end of the year. From January to the end of the year, that is 31st March 2013, those are 3 months. Those are 3/12. So the answer I get from my first formula, I add with my 0.25 shares, the weighted one. So the weighted 0.25 shares. So what do we have based on your calculators? What do you have? Based on your calculators, what are you getting? So for the first formula, you're getting 8.76. Then for the 0.25 times 3/12, 0.0625. Is that okay? So if you add the two, so plus 8.76, 8.82. So this one gives us 8.82. 8.82. So meaning getting the basic earnings per share is very easy because we have the relevant powers. So what I'm supposed to do is all about now taking my powers I divide with 1/0, and I will be done with the basic earnings per share. So the basic earnings per share would be basic earnings per share 83.6 divide 8.82. So shillings what per share? 83.6 divide answer. Shillings 9.4 what? 83.6 divide 8.82. 48 per share. So we are done with the basic earnings per share. So now we move to what? Diluted EPS. Based on the formulas, based on the steps, not formulas, based on the steps, I said. Step 1, I said we do what? We compute basic EPS. We have done basic EPS. We have done the basic EPS. Then now, step 2 is all about determine the order of ranking the securities. The order of ranking the securities, meaning that is where I will start from. So I will have to rank the securities from the one which has a least effect in the dilution of this basic EPS. So when computing the order of ranking the securities, which securities am I going to use? The potential securities. Like, in our question, there are 2: convertible bonds and the stock options. So you need to understand on how they affect basic earnings per share. Will they dilute? Will they dilute basic earnings per share? Or they are anti-dilutive? We have to do the computation and see. So diluted earnings per share. So when we talk about diluted earnings per share, the point we have to start from is to determine the order of ranking the securities. The order of ranking the securities. So the order of ranking the securities, we talk about potential securities. So we'll be dealing with potential securities. Then I will talk about incremental earnings. talk about incremental shares. I will explain why we have these columns. So never worry about that. So incremental earnings, incremental shares, earnings per incremental, earnings per incremental shares. Then you do a rank. So potential securities, you know which securities we are using, the one which are going to be converted to ordinary shares. The examples are already provided. Potential securities, example, convertible debentures, convertible preference shares, stock options and warrants. So why do we have incremental earnings? Like now, let's say, for example, you are having convertible bond. Convertible bond. So if you have the convertible bond, this one can be also called a debenture. Remember that these are in form of certificates which are issued to the people who will lend us money. So they are entitled to what? They are entitled to interest. They are entitled to interest. So we are going now with the aspect of what if analysis. What if analysis, that this security has been converted to what? To ordinary shares. This security has been converted to ordinary shares. Will this company pay interest? This securities is not a bond because now it's converted to ordinary shares, meaning that the company will hold this interest they were supposed to pay. That is why we have an earning which is increasing based on the interest they will hold. Then since they converted the security to ordinary shares, that is where we have incremental shares. Then for these earnings per incremental shares, you divide this and this, you get this. So I've already explained why we have these columns. So in our question now, we have two potential securities, convertible bond, stock options. So before I continue, I need to explain this based on the notes which you already have. So if we go to, let's say we are talking about convertible bond. Let's say I will be talking about convertible bond. These notes, they always express those potential securities very well. Remember that bonds is just loans. So they are saying that it requires the same approach as convertible preference shares. If they are converted into ordinary shares during the financial period, then the shares will be included in computing basic earnings per share from the date of conversion. That is what we did. Remember that the total value of the convertible bond was 25 million. Out of the 25 million, they converted 10. So we included that. We checked how they converted based on the proportion given, and that one was included in basic earnings per share. If they are converted into ordinary shares during the financial period, then the shares will be included in computing basic earnings per share from the date of conversion. That is what we did. If no conversion takes place, then we assume conversion took place, whatever analysis. Like now, even if I will be including the 10, because 10 was specifically converted to ordinary, the remainder is 25 minus 10 is 15. The 15 million convertible bond, they never said if they converted or not. What I will do with the 15 is an assumption. If no conversion takes place, then we assume the conversion took place in order to compute the diluted EPS. Adjustments are made to earnings by adding interest net of tax, meaning that I have to multiply with 0.7. Net of tax is 1 minus tax. 1 minus 0.3 is 0.7. And adjustments are also made to shares by adding the new shares that could be issued on conversion. Where relevant, the interest and shares will be prorated based on time. Just like convertible preference shares. Convertible bonds, that is convertible loan stocks, can either be dilutive or non-dilutive. The process of checking for dilution also again involves computing basic and incremental EPS. I think that one is self-explanatory. Is self-explanatory. So now, according to what I have said, we do the first security, we check the incremental earnings and incremental shares, convertible bond. Do you know that out of the total value of the 25 million, there's a 10 which was converted. So this one, our financial year, you know, it runs from 1st April 2012 to 31st March 2013. Conversion took place when? That is according to note 4. 1st January. 1st January 2013. So the total value of the security was 25 million. They converted 10. So yes, I will deal with the total 25, but I have to separate it. First, I need to recognize the 10. Then I recognize the 15. Remember that the 15, we go with the assumption. But this one was specifically converted. So we have to do the both 10 and 15, but this one we assume that they converted it. Since it pairs the word convertible, the total 25 is a potential security. So net of what? Net of tax. That is why in the last additional information you can see we are provided with corporation tax rate of 30%. The corporation tax rate of 30%. So what I'm supposed to do here, the contractual rate is 12%. So it's a 12% bond. 12% bond. So here I will say the interest, 12% of the 10. So up to the time of conversion, from April to January, how many months? Because this is 3, meaning that this is 9. So up to the time so that is fine. So 12% times 10, the converted up to the conversion. So we prorate. So we say it net of tax. So 1 minus tax, 0.3, 0.7. Net of tax. So that is 0.7 plus. So I say now we have to recognize the 15. 12% times the 15. But now this one, remember that this 15 was from the initial period, from the start of the year. So we say 12 over 12. Remember that it's not that 12, the 15 came on 1st January. That is what most of the students get a challenge on. It's only they converted 10 on this date. It's not that they introduced the 15 on this date. This 15 was there from the start of the year. Times again 0.7. So we get the answer there. We will get the answer. So you can give me the answer. So 0.12 times 10 times 9 over 12, we prorate, times 0.7 plus 0.12 times 15 times 0.7. 1.89. 1.89. So the 1.89. So we talk about so this one was earnings. We have dealt with the earnings. So we move to shares. So on how they were doing what? They were converting. So remember that at the same time, we know that it's all about up to the date of conversion is 9.3. Remember that from the initial period, it was 25 million, the value of the bond. Here they converted 10. So in which proportion were they converting? They said in note 4. In note 4, they said the proportion is shillings 10,000 of the bond. Shillings 10,000 of the bond is converted to what? 250 ordinary. The 250 ordinary. So we have to do the 10 first. Remember, I said the total was 25. They converted 10. Then for the 15, we go with the assumption, what if they converted that for the purpose of computing this diluted EPS? Once we know it's a convertible security. So we say 10 million, then the rate I would consider the 15 million. So we cross multiply this up to the time of conversion. We prorate. So meaning that here I would say 10 times what? Times 250. You divide 10,000 up to the date of conversion of the 10, 9/12, plus 15 times 250 over 10,000. So this one is from this 15. Remember, it was there from the initial period. It's only that they converted 10 during the year. So this is 12/12. So what do we have? What do we have? So if we take 10, this one, we can even reduce and avoid wastage of time. This one goes with this goes with this. So meaning that it's 25 divided by 100 times 9/12 plus, so this one goes with this. So the first one is 0.1875 plus what? So 15 times 25. 15 times 25, what do you have? Divide 1,000. So 0.375 plus the 0.1875. You have 0.5625. Is that correct? Is that one correct? I think you are using your calculators.
Yes, it's correct.
So meaning that to get now earnings by incremental shares, we divide this and this. So 1.89 divide 0.5625. So 1.89 divide 0.5625. 3.36. So we are done with the first potential security. So we do the next, stock options. The option that they are going to do what? To sell at a lower price in the future. What are they selling? Are they selling shares? They are selling what? Yes, it's shares. So remember that I talked about this. I can again talk about it. The company is requiring to sell at a price that is less than the market price at a future date. That is when the options or warrant owners exercise their rights. There's this a billionaire who did the exercise of the options. The owner of who? The one who was buying Twitter, who was bidding to buy Twitter. The Twitter guys. There's no Twitter guy here. Manyinyi mnatumianga which social media platform? Amada amgo social media. Anyway, that is a story for another day. So you can go and check for that. So we are saying that if the exercise is carried out during the financial period, then in computing the basic EPS or the shares on issue on exercise are included from the date of issue. I said that if they were to exercise the option, we were to include that shares with the exercised in the computation of basic earnings per share. But if there's no exercise, like in our scenario, we assume exercise took place for the purpose of computing diluted EPS. How will this affect us? How will they affect the earnings and shares? IS33 recommends that only the bonus shares. We only record the bonus shares in computing diluted EPS. Bonus shares. That is on the scenario when they have not exercised. We do an assumption that they exercise. Then we do what? We compute diluted EPS whereby we recognize bonus shares, meaning that our incremental shares will be affected by recording the bonus shares. No savings is made to earnings, meaning that the earnings is 0. And therefore, an adjustment is only made to one-offs the shares by adding the bonus shares. So Elon, yes, Christine, that is the guy. So, so remember that we have said no earnings. The earnings will be, there's no savings. It's only that we record what? Shares, the bonus shares. So the shares, the bonus shares. So this is how you get the bonus shares based on the prices they were to exercise the option. So they said that according to the question, which is here, according to this question of ours, they said that in this additional information number 5, on 1st January 2013, employees of the company were granted share options to purchase 1 million ordinary shares for 30 shillings. The average market price was 48. The average market price was 38. The average market price. The average was 48, and that is what we state our shares of 1 million at. That they were given an option to purchase at what? 30, meaning that the bonus is 18. So what about that? So the 18 is what we need to equate with, because it was at a lesser price by 18. So 18 times 48, 18 times 1 million, 18 times 1 over 48. So that is what I will be doing here. 18 times 1 over 48. When were they to exercise? They were to exercise this option from 1st January. So you consider from 1st January 2013 to the end of the year, which is 31st March 2013. Those are how many months? 3. Those are 3 months. So you say 3 over 12. That is how you get the bonus. So you say 18 divided by 48 times 3 divided by 12. That is 0.09375. So 0 divided by 0.09375. So you get 0. Those are the two potential securities. How now are they going to affect my basic EPS? How will they make my basic EPS to be diluted? So which security has a least effect. Which security has a least potential in diluting basic EPS? This is the one which has a least potential. That is my number one. Then this one is the second one. So 0, 3.36. Based on the ranks, I will be able now to compute the diluted EPS. I will be able to compute the diluted EPS. I will be able to compute the diluted EPS. So I can be able to use this side here. So diluted EPS will be, so I will say potential securities. I will write in short, potential securities. I will talk about earnings. I will talk about earnings. I will talk about shares. I will talk about shares. And I will talk about diluted EPS. I will talk about diluted EPS. So the first thing we do is to start from basic EPS, from basic EPS. So the earnings, in short, the pause was 83 point something, 83 or 82. Pause. Our pause was, guys, students, or I call you my seniors.
83.6.
80?
83.6.
One was? It was
8.82.
8.82. Then this basic EPS was 9 point. The answer after 9.48. So the security which has a least effect in diluting this is stock options. So we talk about stock options. Talk about stock options. So earnings is 0. There's no savings made to the earnings. Shares is 0.09375. So add this, you get what? 83.6 plus 0, 83.6. 8.82 plus 0.09375. 8.91375. Divide this and this. 83.6 divided by answer. 9.48, 9.38. 2 decimal places. You can see it's now reducing. It's diluting 9.48, meaning the stock options is a dilutive security. Number 2 was bonds. You know, it's convertible. It's only that I'm writing in short. It's convertible. It's a potential security, 1.89. Earnings. And this one is 0.5625. So 83.6 plus 83.6 plus 1.89. 83.6 plus 1.89. That is 85.49. Yeah. The other one, 8.91375 plus 0.5625. That is 9.47625. Divide this and this, 85.49. You divide 9.47625. Divide answer 9.02. 9.02. So you can see it's reducing. So my diluted earnings per share, which one is diluted? Earnings per share is now the 9.02 per share. That is how you do it. And that is how you are supposed to do this question. Thank you for your concentration. If you have a question, you can put a close. So based on what we have done, I will give out an assignment of September 2021 question 2. Let us just look at it, even if I will not do it. So they are saying the foreign capital structure rates to share remittent. The same way they were saying in the previous question. So here you are given ordinary shares, 10% cumulative preference shares, 12% convertible loan notes. You are given profit after tax for the year. Remember that for the profit after tax for the year, for the question we have done, it was in note 1. Additional information number 1. On 1st February 2020, the company issued 1.5 million ordinary shares at full market price. This one was our additional information number 2. Additional information number 3, according to what we have done, here is additional information number 2. They are saying on 30 June 2020, the company made a rights issue of 1 ordinary shares for every 4 ordinary shares held on that date. The exercise price was 36, and the market price on the last quotation was 48 per share. Number 3, convertible loans were issued on the year 2018. We are in the year 2020, remember? It's even 2021. So I was saying that number 3, they are saying that the convertible loan notes were issued in the year 2018. 10 convertible loan notes are convertible into 1 new ordinary shares. The number 4 and number 5 is just what you know. On 1st October 2020, the employees of the company were granted share options to purchase 1 million ordinary shares at shillings 30 each. The average market price was 48 per share. As at 1st December 2020, none of the employees had exercised their options. The corporation tax rate is 30%. There's nothing which has changed here. So I want to see how you will do this. I don't have to say anything. So that is the end of the session today. We meet next time, that is tomorrow. We do another question, which has the aspect of the rights issue and share split. So I will introduce the aspect of share split. Then God willing, on Thursday, we will agree on a meeting. We do another question which has a bonus and reverse split. Then I will check maybe one question to add on what we have done. And we recall that EPS is done. We introduce group accounting next week. You can have a nice time.